Bollinger Bands. Today we're going to look at what they are and how they actually work. And then I'm going to show you 5 backtested strategies that have proven to consistently deliver winning results to many traders. So let's get cracking. Bollinger Bands were developed in the 1980s by a financial analyst called John Bollinger. And this guy is considered to be one of the pioneers of modern technical analysis. And he set out to address the limitations of fixed width trading bands by incorporating market volatility into the bands using something called standard deviation. Put simply, fixed bands maintain a constant distance from each other, whereas Bollinger Bands adjust their width based on volatility. The concept was pretty revolutionary at the time, and worldwide traders in stocks, forex, cryptos, futures and options use them daily. So let's break down exactly what we see when we add the Bollinger Bands to the chart. First thing to look at is the middle band, which is this line here. And this is simply a 20-period simple moving average, SMA, showing us the average closing price over the last 20 candles. The upper band is this line here, and this is a 20 SMA plus 2 standard deviations, and this dynamically adjusts based on recent price volatility. And this lower band here is the 20 SMA minus 2 standard deviations. Now, what are standard deviations, I hear you thinking to yourself? Well, it's just a measure of volatility, telling you how much the price tends to move away from the average. The further the current price is from the average, the higher the standard deviation, meaning more volatility and therefore wider bands. So essentially, you have a channel, and 95% of the price action is expected to stay within this channel. And that's useful to us because it gives us a real-time read on where we might expect the price to bounce, reverse, or break out. So in theory, only 5% of the price action is expected to break above or below these bands, so when the price actually does break outside, it may be a sign of extreme volatility with a breakout or a reversal signal. This is what makes the Bollinger Bands so powerful. So let's have a look at how we actually interpret them. When the bands contract tightly together, it means volatility is extremely low. And this often leads to explosive breakouts. So you can look for a squeeze around support and resistance levels for high probability breakouts. In strong trends, the price doesn't just touch the band, it rides it. A common mistake though is to short just because the price touches the upper band. But if momentum is strong, that upper band can become a launch pad. So let's have a look at 5 popular strategies that you can use with Bollinger Bands. Strategy 1, mean reversion. This is a strategy based on the notion that the price often tends to revert to the mean or average, basically back to the 20 SMA middle line. And this works really well in sideways markets. So when the price touches or closes outside the upper or lower band, watch for signs of exhaustion like a doji candle or a drop in volume, and then wait for the price to start reverting back toward the middle line. Or when the price closes back inside the upper band, you could consider going short and again exit when the price hits the middle line. Notice how this works really well in sideways markets when the bands are fairly tight and flat. Strategy 2, Bollinger Bands and RSI reversal. A good strategy is to combine the Bollinger Bands with the RSI, which is an indicator that measures how fast and how strong the price moves over a recent period, spotting when a stock is overbought or oversold. So if this purple line breaks above this 70 line, then this stock is considered to be overbought, and we could see a pullback. If the line breaks beneath this 30 line, then this stock would be considered to be oversold, and we could see a bounce. So when you combine the RSI with Bollinger Bands, you look for when the price touches the lower Bollinger Band, and if the RSI is below 30, then that would be a good indication to go long. For extra confirmation, wait for the price to pass the yellow moving average line before placing your entry. For a short position, you look for when the price touches the upper Bollinger Band, and if the RSI is above 70, then that could be a good indication to sell. A good time to exit the trade would be when the price returns to the middle band, or if you believe the trend is strong enough, then exit at the opposite band. Strategy 3, Bollinger Band squeeze. This is a very popular strategy where you look for areas where the bands are tight together and the middle SMA line is fairly flat. Now this signals low volatility and a potential big move could be coming up. So watch out for a breakout above the upper band and enter long when the price closes above the upper band. If you look a little earlier, you can see a similar pattern emerging, and you would think that this could potentially be a good place to go long because of this breakout here above the upper band. But if you'd gone long here, you would have lost out as the price then dropped straight back down. That's why it's always good to cross-reference a breakout with volume. If there's no volume, then a breakout will likely not amount to anything. But with lots of volume, a breakout will likely turn into a new trend. And to prove this, let me add a volume oscillator to the chart. And there you can see at the fake out, there is very little volume, but on this actual breakout, there is a lot of volume. So there's your confirmation. Strategy 4, trend pullback. In strong trends, the middle band, the 20 SMA, can act as a dynamic support or resistance level. So we can use it to ride the trend to help time an entry. So in an uptrend, you can wait for a pullback to the middle band, and when you see a bullish candle again, that's your indication of a good time to go long. In a downtrend, wait for a pullback up to the middle band, and when you see a bearish candle again, then that is your indication of a good time to go short. So you can see this downtrend started here. Well, after it hit the bottom band, it pulled back to the middle 20 SMA line twice here before making a nosedive. So these points would have been two good opportunities for a short. And strategy 5, double Bollinger Bands. For this strategy, we're going to use two Bollinger Bands on the same chart to create distinct trading zones, which will help to visualize the volatility better and filter trades based on market strength. So both Bollinger Bands will be using the same moving average length of 20, but each will have different standard deviation settings. The first one with 1 standard deviation and the second with 2 standard deviations. So let's add another Bollinger Band to the chart, and we'll go into the settings of this new one and change the standard deviation from 2 to 1. So you'll now see the central 20 period SMA line and 2 inner bands with 1 standard deviation and 2 outer bands with 2 standard deviations. This creates 3 price zones. Zone 1, inside 1 standard deviation. This is a low volatility area and would not be a great time to enter trades. Zone 2, between 1 and 2 standard deviations. This is the momentum zone. Now if the price stays in this zone and hugs the upper band, that's bullish momentum. And if it hugs the lower band, then that's bearish momentum. This is an ideal zone to enter trades in the direction of the trend. And zone 3, outside 2 standard deviations. Now this is the overextended area, and if the price is outside the outer bands, it means it's an unusually strong move and could mean a breakout continuation if it's supported by volume, or it could mean a potential reversal if the move is unsustainable with low volume. So how do you trade this strategy? Well, you need to look for when the price closes above the 1 standard deviation line, the upper momentum zone, to place an entry. Place your stop just below the 20 period SMA, the middle line, and exit the trade when the price reaches the 2 standard deviation band or when it shows signs of slowing. So that's 5 Bollinger Band strategies there for you. Now, if you're a short-term trader and you're scalping, then you might want to consider tweaking the Bollinger Band settings slightly to suit your trading style. So instead of the 20 period SMA, you could try a 10 period SMA for tighter signals. For longer term traders, you could use a 50 or 100 period SMA to filter out the noise. And remember, as always, only try these out in demo mode until you're fully confident in what you're doing. So that's everything you need to know about Bollinger Bands, from the basics to 5 fully back-tested winning strategies. If you got some value from this video, then please give it a like and consider subscribing to the channel if you haven't done so already. But for now guys, thanks for watching, good luck, and I'll see you next time right here on Math Market.